This is 93 Million with Doug Andrew. Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, and lover of smoked brisket. And in today's show, we're talking about the different types of taxes, the myth of being in a lower tax bracket in retirement, and the truth of precious metals. Ooh. And also, what does three-dimensional wealth mean anyway? And we're joined by the OG of properly structured IUL, New York Times bestselling author, and the author of the Laser Fund and founder of Three-Dimensional Wealth, Doug Andrew. Welcome, Doug.
Yeah, great to be here as always.
The master of the max-funded IUL, co-author of the Laser Fund, and a man with no shortage of opinions on the PC versus Mac debate, Emran Andrew.
Just the right opinions. Just the right ones.
And a technician of IUL, also co-author of the Laser Fund, and a man who loves a great steak, Aaron Andrew.
Thank you. Yes,
a great steak, not a well-done steak.
Yes,
great steak.
I just ate a steak just barely.
Yeah, all right. All right, and one of the original converts from Whole Life to IUL, the president of Laser Financial and top IUL specialist, Brandon Johnson.
How do you do?
Welcome, Brandon. It's good to have you. Okay, we have lots to cover today, starting with our first segment, tariffs. The great market maker. I think the biggest news in the last week, and in fact the past few months, has kind of centered around tariffs, of course. Well, in the last week, according to Fox News, the stock market soared after news that the Trump team and China dramatically lowered tariffs. Doug, this often happens where we see a headline like this, and the market soars upward, or it's a negative headline, the market goes down. Why do news events affect the stock market so much?
Well, again, because usually Wall Street is myopic due to the media and how it reports perceived bad news, okay? It's sort of like reactive instead of proactive. I like to compare it to, okay, if news comes out, is the glass half full or is it half empty? And the news media seems to focus on the emptiness.
Right.
And so everybody gets alarmed and they sell and it drops down instead of looking at the longer picture. And then when the market finally comes back and everybody who was all bummed out because their IRA or 401k accounts were down 10%. Oh, wow, the market's up over 1,000. Now, now it's a hero. And they're just like, right. I get tired of that.
So up and down.
It's like the bad news bonanza. Yeah. Usually good news has to be preceded by bad news. In an intersection, before the good news of a stoplight, usually there was bad news, somebody got hurt or killed in that intersection. And so when there's good news in the market, that was usually preceded by some bad news, which was very short-lived.
Yeah. Emran, what are your thoughts on this?
Well, like Doug said, the media loves drama. What's good TV? Good TV is high drama.
Yeah.
And, so if you can create that drama and create more dramatic storyline for this, it creates that. And so that more knee-jerk reaction. And the thing is most of us sadly do make financial decisions more emotionally than we do logically.
That's a good point.
And so, you see something right there and you get these knee-jerk reactions. We make decisions emotionally, which then causes a ripple effect and more people. And then you got that FOMO, like, oh my gosh, I don't want to lose too much. I'm going to get out. Or if it's going up, I don't want to miss out. I'm going to get in at the high. I mean, it's like we talked about in a prior episode, Dalbar's reports. Yeah, the S&P might have an average return of X over so many years, but the average investor ain't getting anywhere near that. They're getting like 3.5% compared to the average return of 10%. And
they're buying and selling.
Yeah,
at the wrong time.
because they're doing it emotionally.
Yeah,
it drives me crazy when people talk about, I just put my money in the S&P and leave it there and earn 10%. Did you? Because according to Dalbar, no, you didn't. Because you always jump in and out at the wrong times.
Right.
It's the emotion.
Yeah, that's a good point. Aaron, what are your thoughts?
Well, looking at it, it's like, the market reacts and the algorithms of the computers and also investors, when news comes out, it's an expectation of future returns.
Right.
And so they're looking at it and they're saying, okay, if something happens in the news, it's like, all right, what immediately is that going to affect in the future here? And so the market reacts good or bad.
Because they don't have the whole story, right?
Yeah, because they're looking at the
software programs, AI. They don't have the whole story.
So like, okay, what does this mean going forward? Because a price of of the stocks is just anticipation of the next quarter.
Right, that's a good point.
So they're looking at like what's going to happen. So it's like
It's almost perception of what it is, rather
so
than
like
what the data is.
So the tariff thing, for example, is like all of a sudden all this bad news, like people thinking, okay, it's going to affect the markets. So the markets, anticipate that. Boom.
Right.
All of a sudden things settle down. It's like, back up because things are settled down now. So it's like kind of interesting.
Software and algorithms AI is causing a lot of problem with
the world that we live
with investing.
Brandon, wrap us up on this segment. What are your thoughts?
I mean, the recent, tariffs, what we've seen over the past month is a perfect example of this. It's optimism versus fear, right? And so when there's optimism there, these traders, they're buying, they're expecting, more supply, because now recently we've seen the tariffs, we've seen some good deals just recently get done. And all of a sudden we just saw the stock market soar, but we've seen the adverse where there was fear, right? And they thought, okay, there's not, the supply chain is going to be low. Therefore, people were getting very nervous. And so we saw, stocks plummet a little bit. So it is very finicky. I think these professional traders are often reacting to the anticipation of news rather than the actual report that comes out. So everything's kind of done in anticipation.
Yeah.
They got to quit making the short-term news the long-term reality. Like they're making decisions if this is like long-term reality.
Doesn't it seem like the market moves in much bigger swings than it ever used to?
It's so much more volatile.
And based on
because all these algorithms,
just within a single day, and we're so interconnected with the internet and news headlines.
It's funny. I talk about emotion, like humans making decisions emotionally.
Yeah,
it seems like AI and these software algorithms are way more emotional than even human beings.
That's funny.
I was reading, so it was like milliseconds. Like some news comes out, milliseconds are deciding something, and stocks go up or down.
It's knee jerk.
What's going to
Or
happen?
if you're a politician, it's before the news comes out. Okay, I'm sorry. I think Doug had one other thing. Go ahead, Doug.
No, I'm good. I just people need to just calm down and think of the big picture and quit reacting. Be always in a position to act, not react.
Yeah, and that's good. And put yourself in a good position in the first place so you're not reliant on all these unpredictable factors, right? Okay. Well, coming up later, are precious metals really that precious? But first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe. And hey, ask us a question or comment. We may use it in one of our next shows. Okay. Taxed as earned, tax-deferred, tax-free. That's a lot of taxes. Doug, we often hear about the different taxation of different vehicles and different situations. There arises some confusion as to how different financial categories are taxed. Can you explain the differentiation of these categories?
Absolutely. One of my favorite topics. Let's go to the wisdom table. And I'm going to show you what I drew out on a napkin over 45 years ago when I had a conversation with another financial advisor. There's 4 phases of retirement planning. There's the contribution phase, top left, where we're contributing money towards these investments for our future. It overlaps the accumulation phase where hopefully you're earning interest and dividends or growth. But someday you're going to take withdrawals. And the problem is too many people go into withdrawal when they hit that phase because of the amount of tax they start paying. So that's the distribution phase, which is actually the most important. And then none of us are getting out of here alive. I don't mean out of this podcast, Brandon. I mean out of this life.
At least not
you. So we usually leave behind something that would have sustained us had we lived longer. That's called the transfer phase. Okay. Yeah. So we are going to look at 4 different savings alternatives. Okay. Now, the first is the worst, but it is the most common way
That's a lot of red.
Americans save. Okay,
and the second is the same.
Investments. Okay, these are bank accounts, credit unions, regular mutual funds that are not IRAs or 401k. So you look across the top there, and if we were running $1 million dash, and the goal is to get $1 million net after taxes, fees, this should be like crawling around that racetrack to get to that goal, because you put money to bank or credit union, you're taking after-tax money, and then every year you're paying tax on the interest or the gains, the dividends, and then when you go to access the money, or if you're going to be distributing, taking that money, it's now taxable again on any gains or what have you, and it's taxed potentially again when you die. In other words, 4 red circles. I'm going to keep this very simple here.
Yeah.
Now, a lot of people, they want to crawl. They don't know they're crawling, but this is where you take after-tax dollars and you put it into something that's tax-deferred, not a qualified account, but like an annuity, okay? It's only tax-deferred, but you're funding with after-tax dollars. But when you go to access the money and take withdrawals, it's now taxable LIFO, last in, first out.
Yeah.
The last money you're earning, the interest is the first money coming out. Only if you're dipping into your basis are you getting that out, because that's already been taxed and you have to be taxed on that. So that's one green circle. Now, let me use this metaphor. If you were a farmer, let's say, and you had the choice of buying your seed in the springtime, and you didn't have to pay tax on the price of the seed. You plant that seed, you irrigate, you cultivate, you water, you work hard, and in the fall you harvest your crops. And now you agree to pay tax on what you sell your harvest for. Okay, that's a traditional IRA or 401k. You get a tax break on the seed money, but you agree to pay tax during the harvest. Now, if you think that taxes are going to be lower in the future, that might be a consideration, but most savers are not in lower tax brackets. We'll probably get into that a little bit later.
Yes.
And so if we look at this chart again, if we take and we get a tax break on the seed money and it accumulates tax deferred, traditional IRAs or 401ks, then you go to retire and you got 2 big red circles, okay? You have to pay tax on the back end. And that's why when people would first come to me at retirement, which is totally different planning than for retirement, I would tell them to bring their after-tax IRA 401k statements. And they would say, after tax? I knew they didn't have them. And so I'd have to show them that $1 million nest egg isn't all their money. The government has a permanent tax lien on that thing, and it's the best savings bond the government ever came up with for themselves. So that $1 million is only about $700,000 is their money.
Yeah, because those 2 red circles are kind of a surprise to a lot of retirees. When they hit
they're
that, right?
shocked.
It really
I can't
is.
believe how many people you mean I have to pay tax on this?
Yeah.
Right.
Where have
right.
you been?
It's been green circles this whole time. What
They're
happened?
like waking up in the Matrix.
Right.
Well, I was,
Wait a minute. What?
Well,
like, I was 24 years old when I started. Nobody explained this to me.
well, people think they're going to have more because they have more growing in there for them. It's like, oh, I got more in there still. It's going
Yes.
to grow more. It's like, no, you got to do the math.
You
Nope.
still have to pay on the harvest.
Yeah.
Doug gives you the red pill.
Yeah.
Or the
Yeah.
blue pill.
Yeah, that's right.
And so I ask, well, if you're convinced that taxes in the long run will likely be higher, which most Americans do, okay, I would rather pay tax on the seed, the red circle on the contribution. I'd rather pay tax on the seed money and let my money accumulate tax-free and then be able to access that money tax-free. But some people say, oh, you're talking about a Roth. Well, yeah, a Roth is a step in the right direction. But if you've ever heard me, I've never owned an IRA or 401k, but I've never owned a Roth. And never will, because it doesn't have the third benefit. When I die, what I leave behind transfers tax-free and often blossoms, increases in value. So there's only one vehicle that does that in the Internal Revenue Code. Accumulate your money tax-free under Section 72E. You can access that money income tax-free under 7702. When you die, it transfers income tax-free under Section 101A. It says up here, MFTA, that's Max Funded Tax Advantage, Section 101A alternative.
I'll have one of
So,
those, please.
yeah.
Yeah. Give me
So
a slice of that
I asked
pie.
my audience,
I'll have what he's having.
Yes, please.
it's simple. I asked my audiences, how many of you want to keep your money in 4 red circles? How many want just 1 green? How many want 2 green? How many would like to have 3 green circles, okay? 3 green circles, mathematically, I'll show you right now, is way better. It's 50 to 100% better, okay? So let's take $1 simply doubling, okay? On the far left column there, $1 doubling for 20 periods goes to 2 to 4 to 8 to 16. Okay, it'll go to $1,048,000. If that is tax advantaged. If it's taxed as earned, the first choice, 4 red circles. $1 doubles to $2. You pay tax in a 25% bracket. You only have $1.75. $1.75 doubles to $3.50. The next year, you only have $3.06. You only have $72,000. 7.2% of $1 million in a 25% bracket.
That is ouch.
What about a 33% bracket? How many of your clients between federal and state are in 33% brackets at retirement?
There's a lot.
You only have 2.7% of what you could have had. And that's the way most Americans save. Now, tax deferred, you end up with $1 million in those IRAs or 401ks. Tax favored, which is my favorite, MFTA, you have the same amount of money. And so people say, well, Doug, what's the diff? You both have $1 million. Here is the answer. You don't choose investments based upon which ones grow to the most. you choose investments based upon which ones generate the most at the time in life you're going to be using the money the most. So
there was a point of wisdom right there. There's a Doug. That's a wisdom.
Yeah, that was a gem.
That's wisdom. That's a gem of wisdom.
So using a golf metaphor, let's go to the back nine of an 18-hole golf game of life, okay? So let's say you needed a net of $100,000 to buy gas, groceries, prescriptions, and golf green fees, and you're pulling out 10%. The taxable option, people are out of money 1 year into retirement, relying on Social Security, charity, welfare, of their children for support. The IRA or 401k, second to the last right on the right, tax deferred, $1 million, you have to pull out 50% more in a 33% bracket. To have 100, you have to pull out 150,000, pay tax of a third, 50 to net 100.
Yeah, not 30% more.
Yeah. But if we take a late retirement and an early death, that can still work.
Yeah, that sounds familiar.
But look, you're in an IRA 401k that started out with $1,048,000. You're out of money at age 76 in 11 years, and now you're relying on Social Security, charity, welfare, of your children for support. Look at the one on the right. I pull out $100,000. It is tax-free. I net $100,000. I still have my $1 million, and it's staying ahead of inflation. If I were to go 20 more years, because the fastest growing segment of American society today are those reaching over the age of 100. If me or my spouse makes it another 20 years, I had $100,000 a year for 20 more years. That's $2 million. And I still have my $1 million. That's a $3 million better retirement strategy than the same amount of money at age 65 in an IRA or 401k that runs out. Other than that, I don't have any strong feelings on this subject, okay? But this is like sprinting towards the finish line of retirement.
It sounds like you know what you're talking about. It sounds like you could go on this subject for a little longer.
Oh, yeah, you want me to?
No, that's okay.
That's all right. We're good.
With that in mind,
I didn't want to know that much about it.
Yeah, exactly. Hey, okay, let's do lightning round for the rest of you guys. Okay, lightning round. Just quick comments on this, and then we'll move on. This is a great segment. But Brandon, what are your thoughts?
My thoughts are, people, they think about retirement, they you want to be diversified, right? So we often talk about diversification with investments, your retirement portfolio. So typically that's going to be like IRAs, 401ks that people are typically in. Maybe it's real estate, maybe it's precious metals, but they don't often talk about or understand diversification in taxes. Mm-hmm. How will those vehicles, how will those financial instruments be taxed when you start taking distributions?
Right.
This is the topic that we're really impressing upon our clients is how are you going to be impacted? What kind of tax burden will this create? Let's get you in a more efficient, effective tax bracket based on where we position this money and what instruments that we're using to be more tax favorable.
Yeah, so not just thinking risk paradigm, but like tax paradigm.
Exactly.
Yeah,
that's awesome. So Aaron, thoughts?
Out of all my clients, the clients that are the happiest or those that the product they like the most is tax-free.
Yeah.
Tax-free. In retirement,
it's a good feeling.
I wonder why.
All these different accounts, and their favorite is, wow, I can pull from the IUL, and it's going to be tax-free.
Love it. Emron, wrap us up.
I mean, 3 green circles, right? Three green circles. In the time of life when you retire, you need predictability.
Yes.
I mean, and so that's where do what you can, be smart to create greater predictability in retirement.
Yeah.
Not to mention, you can take money out and put it back, which you can't in those others.
Yep.
Oh, yeah.
And you can take money out before 59 and a half.
Yep.
You have the death benefit, but that's enough.
Yeah,
that's good.
We can go on and on.
We can go, and we do. We have many more episodes and past ones you can watch as well. Okay. Will I be in a lower tax bracket in retirement? This is a great segue, okay? According to a CNBC article, you may not be in a lower tax rate in retirement. The article says that some retirees won't be as lucky due to factors like large RMDs, which stands for required minimum distributions, or withdrawing more money to fund a period of jubilation, it says. That's kind of an interesting, weird phrase to use, but at any rate, those are the only reasons, according to CNBC, that someone might be in a lower tax rate in retirement. Emron, is CNBC missing anything here?
I think they're missing the whole vision of retirement.
Yeah.
I thought that was supposed to be your golden years, not a moment of jubilation. I thought retirement was supposed to be a whole era
If you're lucky,
of jubilation.
If you're lucky,
Right?
Like some random people plucked out of society.
Right? I mean, obviously, if you don't save, you're not going to be in a higher tax bracket. But if you save, our system is built to where you are going to lose your 3 largest tax deductions. This is a conversation I have with my clients all the time.
Yeah.
Okay, when you retire, more of your income is exposed to taxes due to the fact that we typically lose our 3 largest tax deductions. Simply put, most people are like, well, I'm gonna my mortgage is finally paid down or paid off. Yeah, you finally got that stupid thing gone, right? My kids are grown. And then there's the biggest one that most people don't even think about. And that is your IRA and 401k contributions. Like right before you retire, you're shoving as much money as you can into these retirement accounts because you're like, the retirement's coming. I got to shove as much money in. Every dime you put in there is a tax deduction on your working years. But when you retire, are you still putting money into those accounts? No, not only are you not putting money in, you're doing what?
Taking money out.
Taking money out.
And so your income can go down, and people don't understand. Your gross income can go down, but your tax exposure goes way up. And so more of your money is exposed to tax. It's not your gross income that's important. It's your taxable income that's important.
And on top of that, a lot of these people could be business owners where they were used to, through their earning years, writing off a lot of business expenses, having a lot of write-offs, a lot of business expenses. All of a sudden they retire, they sell that business.
They're like, dude, I got my big payday. And now
I don't have any deductions.
The tax man is
They're like, wait a second, all this stuff I used to write off in the business, I can't anymore because I don't have a business.
That's a great point. So many people don't even kind of acknowledge or realize that. Brandon, should if someone wants to be in a lower tax bracket when they retire, should they just save less money? Is that the answer? Or is there a better way?
If you want to be in a really low tax bracket, just live off Social Security.
Yeah, that'll do it.
That's the plan.
No, Uncle Sam would love it if you were in a high tax bracket in retirement. They love that.
Yeah, exactly. Now, being an IUL specialist, a top IUL specialist, is there a better alternative that might exist?
Absolutely. I mean, Doug,
you better answer this right. You better get this one right.
Doug
I set you up for that one.
Right on the 3 green circles.
Yes.
I mean, after tax money, get it in there, and you have control. I love the control. The clients that feel like I can use this money if I need it, but if I don't need it and I want to pass it on for a legacy, I'm not forced to have to take a required minimum distribution. It gives you the control where taxes are going. You don't have to sweat that. We know in the future, the way we spend money as a government, the programs that we have, we know taxes potentially could go up. And so having that power, that control, that my money is in a bucket that is protected and insulated from taxes and from forced required minimum distributions. I can take distributions of the smart way, the efficient way.
Right.
That's the tool. That's the instrument that we like. That's a max funded IUL.
Well, the crazy thing is like people don't like paying taxes.
Yeah.
So when they retire, they got all this money stuck in these IRAs before. So they go all the way down to the RMD. I have to think of one of your clients, and he can pull out $400,000 a year tax free.
Right.
Now, if he is out of his 401k, he'd have to pull out 800 or more.
Yeah, because that's a huge tax.
Yes, you're in the highest tax bracket.
Per year, we're talking per year.
And so if he had, I know him. And if he had to pay out $800,000 to be able to net $400,000, he just wouldn't do it.
He's like, no.
So he would avoid the moments of jubilation just because he doesn't want to pay the tax.
Even though you got to pay it at some point.
We come across those people all the time.
All the time.
A lot of you come and meet with us, and you're like, and you don't take money out because you don't want to pay the taxes.
You hate.
The IUL, like Brandon was saying, you have so much more flexibility because let's say someone wants to buy a house, they want to take out $300,000. If they do that in their IRA 401k, it's going to bump them up. They have to take out more just to net the $300 for the down payment. Whereas in an IUL, you take a loan against it, tax-free. It's so much more flexible.
It's the anti-jubilation. The IRA 401k is the anti-jubilation.
And we'll talk about meeting with guys like these here in just a second. But I asked ChatGPT the same question, and ChatGPT agrees with all of you. Most people have fewer deductions in retirement, including no 401k IRA contributions. Mortgage interest is gone or it's shrunk because people pay off their mortgages before retirement, right? There's fewer work-related expenses, or I would add business deductions if you're a small business owner, entrepreneur, and dependents are usually gone. Doug, why don't you give us your final word on this subject? And we kind of alluded to it. We talk a lot about IUL or Index Universal Life. What are your kind of final thoughts on this subject?
Well, I think back when our book, The Laser Fund, came out, and I went back to New York and was interviewed by NASDAQ right there in Times Square. Leanne was a wonderful interviewer, and she had actually read the book. And the first question she asked, Doug, explain to my audience about the deduction reduction.
Yeah.
She picked up on that term.
Yeah.
Great phrase.
Because she
that.
thought, our audience, all they do is they look at the front end and they don't realize what's going to happen on the back end.
Yes.
So I've often said it's like going down the highway with one foot on the gas pedal and the other foot on the brake pedal. I wouldn't recommend that. But people, they put money into these tax-deferred accounts, and yet they're killing their deductions as they go. So that's a foot on the brake in retirement, so they don't have those deductions. So as Emran was saying, the biggest reason is most savers are not in lower tax brackets.
Yeah.
Okay.
Yeah.
The foot on the brake, they pay off their mortgages. Okay. The kids are gone, or if they move back in, you can't deduct them anymore. Okay. And then you're not contributing money to IRAs or 401ks. But hey, here's a fourth one. If you're a business owner, and you used to have deductions as a business owner, and you sell your business, you don't have those deductions anymore.
Right.
So people are flabbergasted when they're in as high or higher tax brackets when they retire, even if they don't have an increase in income or this jubilation or whatever. All of a sudden, they're paying more tax because the deductions are gone.
Hey, Aaron, did you just hear that? If we move back in with Dad, he can't deduct us.
Oh, that's not what you want, Doug. That's a lot of family
It's not
members
gonna
moving
get
back
help
in.
there.
I don't think that'll work, by the way.
There'd be a lot of jubilation in the house.
Yeah, I don't know if jubilation's the word.
I can make you dependent more than you realize. Okay?
All right. Hey, if you're enjoying this content and you're wondering how to take advantage of these ideas, like Aaron was just talking about, how do you meet with people like this? Well, Laser Financial helps individuals and families like yours implement proven strategies to grow and protect your wealth. One of our most powerful tools is the Index Universal Life Policy, or IUL. It's not just insurance. It's a tax-free retirement strategy, a way to grow your money with compound interest and a safety net against market downturns. Imagine being protected from market losses while still participating when the market goes up, and having tax-free income that allows you to keep more of what you've worked so hard to save. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait to take the first step toward a brighter, more secure financial future today. Also, are you a financial professional wondering how you can expand your business working with Index Universal Life, or IUL? Are you leveraging IUL to its full potential? That's where IUL Insiders comes in. In the next few weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals to help you build a thriving, scalable business that sets you apart from the competition. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and for your bottom line. If you're ready to elevate your practice and scale your business, visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. Okay, are precious metals golden opportunity or fool's gold? Many people love precious metals, and for many different reasons. And some people feel very strongly about precious metals. Gollum certainly does. All right, this is a bit of a hot button topic, but I really want us to have kind of a good, just kind of an honest discussion about this subject. So let's start off with one take from Warren Buffett.
So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset.
Okay, so Warren Buffett's not too hot on gold. Many talking heads out there are, and it's kind of the greatest thing. Aaron, I want to start with you on this subject. What do you say? Are precious metals a golden opportunity or fool's gold?
I would say that precious metals have their place.
Yeah.
I would say a smaller part. It's like your backup, like worst case scenario fallback. The problem is we have clients that came to us, like let's talk about 2008. After 2008, people were panicking, thinking the whole world's going to fall apart. So I had people come to us that had all their money in precious metals. I'm talking like everything. Like I had one, had like everything in silver. And then after a bit, silver went down, like cut in half. It was like a 50% loss.
I had one that had 1.8 buried in his backyard.
Oh, wow.
$1.8 million in gold buried in his backyard.
What was the address, by the way?
I know, right?
I mean, you look at that. It has its place, but not for the bulk of your money. It's like Warren Buffett says, it's not, going to do a lot long term. It's more of a fallback.
Yeah, like an insurance almost.
In the worst case scenario, have some there, but
peace of mind.
Not the bulk of it. It's not going to, generate you a lot of income, of course.
Yeah, that makes sense. Brandon, what are your thoughts on this?
Yeah, I mean, I think it's gold that kind of comes down to trusting the dollar, right? Most people that in the past, I think they go that all in. I mean, they just don't trust the dollar, the U.S. dollar, the future of it. Here's my hot take is I think that Warren Buffett, he went on and said those things, that made those comments because he wanted to buy gold. So you got all these people selling gold.
And he's buying.
And there's only a finite, there's only a finite amount of gold, right, of this precious metal.
I love it.
So everybody's selling it because they do whatever Warren Buffett says, right? I mean,
conspiracy, Brandon.
No wonder he's made so much money.
And
That's how he does it.
I'll bet you if you find out he after that purchased a ton of gold.
That's great.
So.
No, all right, Everett, what are your thoughts on this?
Well, with anything, you start with the why. Yeah. Start with the why in mind. So why are you looking at the precious?
The swing versus the clubs, right?
Yeah. So if the why is protecting yourself against the collapse of the dollar, great. I mean, have a little bit there, but I mean, just pause for just a minute. If the dollar actually collapses, we have no monetary system, meaning we're going back to bartering.
Yeah.
If it gets that bad, Brandon, I don't care how many gold coins you have. I can't eat those gold coins. I'm not trading you my bucket of flour for a brick of gold. So, I mean, if it really gets that bad, if that's what you're doing it for, is for the extreme, then sure, have a little bit.
The crops growing in your backyard would be precious.
Maybe have a little bit there, but there's no reason to put all your eggs in that basket.
Chocolate would be worth more than gold if you were bartering.
Oh, I feel like that right now, actually. These are great points. Doug, what are your thoughts on all of this? I know you have some good thoughts on this.
Yeah, I agree with Emran. If things get really bad, you can't eat the gold. You've got to be able to convert it to food. You've got to be able to grow carrots in your backyard, which is more important than having a bunch of gold. But let me put it this way. Gold, silver, precious metals, they are designed, as Warren Buffett, I think, was honestly talking. Okay?
I don't know.
I said it.
Troll
it's not a producing
Wouldn't surprise
asset.
me, Brandon.
So what is it if it's not a producing? It's a fixed asset. So gold, silver, precious metals, generally speaking, even though they go through these gyrations, if you take a line and draw through those ups and downs, what you will see is gold, silver, basically keeping even with inflation.
Right.
If you want to keep even with inflation,
not beat it.
Sometimes it beats it, and then you lose it, like 50% after 2008. Okay, so let me use this example: a nice tailor-made tunic at the time of Christ. Okay, over 2,000 years ago was an ounce of gold. Today, a nice tailor-made suit. I have shelled out even 10 years ago for a tailor-made Tom James suit. $2,500, $3,000, which is what an ounce of gold is.
Yeah.
Okay. A tailor-made suit is today what it cost back 2,000 years ago, an ounce of gold.
And you would know.
Oh, yeah.
Sorry. Oh, sorry, I couldn't help it.
I still have a tunic or two
you still
in my
got
closet.
a tunic in your closet?
That wasn't even one of his sons. That was Greg that said that.
I apologize.
But all it does is it just keeps even with inflation.
Yeah.
people would understand
Yeah.
that. They would understand why Warren Buffett was being honest with us.
Yeah, and Aaron, you were showing us a graph of silver. We were just talking about this, but it hasn't even gotten back to the high of where it was. Was it 2008? Right,
2011. Yeah,
2011.
So after the 08 crash, everybody's panicking. You know, and then once again, it's the emotion.
Yeah.
Because everybody's panicking, everybody starts buying it, which forced it to shoot up above what its real value was.
So it's interesting. It's like by the data, it keeps up with inflation, but by the emotion, it's going to go wildly up and down by the emotion.
That's the time I was talking about. The clients came, with so many people that came to us because it was such a craze. They were all buying precious metals,
Right, because
and all of a sudden
it was the fad.
They just lost a ton of money.
Oh, scary.
It all came crashing down.
All right, if you're enjoying this content and are wondering how to take advantage of these ideas, at Laser Financial, we help individuals and families like yours implement proven strategies to grow and protect your wealth. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. Don't wait. Take the first step toward a brighter, more secure financial future today. If you're a financial professional tuning into the show and you're wondering how you can expand your business working with Index Universal Life or IUL, join us for the IUL Challenge. It's a free 3-day event designed specifically for financial professionals who want to master the art and science of IUL. Visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. And now for the podcast comment of the day. We recently received this comment on YouTube. It says, wow, Doug, amazing, ! I ordered your book and have been reading it with my wife. Thank you for showing us the way. I don't know if is this really necessary? Do we really need to read the rest of this?
Keep reading the comment here. Okay.
Okay, all right.
Doug likes
Hold
it.
on,
Okay.
we're going to have to adjust his headphones because his head's getting bigger.
Yeah, that's right. Is this really necessary? Okay, let's keep going. Okay, so it goes on to say, I thought you were a great man from what of your work I've seen. However, after seeing your sons, I know you're a truly great man, for it is by our legacy that we are truly judged. Interestingly, I'm not going to go to you on this, Doug. I'm going to go to Aaron and Emran. Doug's YouTube channel is called 3-Dimensional Wealth.
Before you do, it says, after seeing your son, and now you're asking to hear them?
It's a big risk. It's a big risk.
Don't let me down.
We're gonna hear them now, not just see them. But being Doug's sons, what does 3-Dimensional Wealth mean to you guys?
Yeah, it really means capturing that which is most important. You know, go beyond like Doug always. My dad sat down and really taught to us early on is what are the most valuable assets. When we talk about the word assets, what are assets, and go beyond. Think beyond those financial assets. And it's been a great focus in my life. Understanding, you know, as I look at it, God is number one in my life. My wife, number two. My kids, number three. Family and extended family. You know, my community around me kind of goes in that area right there. And by being able to maintain that kind of a focus and having my values, you know, understanding those are the most important assets in my life, and am I actually treating those as my most important assets? I mean, it's allowed me to maybe even hopefully pass on that same kind of wisdom to my son, who, by the way, is just over here on the other side right here. I don't know if we can get him on.
He does not want to show his face.
Yeah. we got Doug's heritage coming down to multiple generations. Maybe we can get him to come on
Ethan,
screen.
are you even there? Can you at least wave hi to us?
I think he said he just played basketball today, didn't he? So he messed up his hair. Come over here, Ethan. Come wave.
Come poke your head in between.
This is what Doug's
between Aaron and
about.
Emran.
Next generation, right?
This is the next
Multi-generations right here.
The legacy
there you go.
continues.
You got to bend down so you can see it right there. See, so this is
That's Ethan.
Okay, Ethan, say something.
I don't.
Don't you take after your grandpa? You got to say the word something.
yeah. Don't you love? Do you like learning from
You missed
Grandpa?
the joke.
Yeah, he teaches great stuff.
Yeah.
What's your middle name?
Douglas.
Oh, there you go.
there you go.
That's why we brought him in. I see now. I see how it is. That's
But it's
awesome.
pretty cool to have Ethan in the back here working on, you know, the audio video stuff while we're
Yes.
doing this.
It's pretty cool.
You know?
Thank you.
It's
Really,
passing on
really,
the swing.
As an outsider, the kudos goes to Grandma Sherry,
That is
Yeah.
a good point.
the mother of Emran and
That
Aaron,
is a
Well,
absolutely.
very, very
Grandmother.
good point.
of Ethan.
To warn you, I mean, Doug's got 17 grandkids. 20 actually. My sisters just got remarried a while ago. So I got 20 grandkids, and my kids, they just said, "Wait, Ethan's over here working?" And so my daughters want to come over here.
They don't want to come and work.
So my daughters were here yesterday. We came here for a minute, and they, I love the set. They want to come and they might steal your
They just
spot.
came over here to ride scooters. What are you talking about?
All right. Thank you, Ethan. Appreciate it. You're cut loose. Good job.
Yeah, way to
You
go,
did
buddy.
it. We're proud of you.
He's a lady killer.
All right. You make Aaron. Why don't you finish us off on this? Well, we'll have Doug finish us off. What are your thoughts? And then we'll come back to
I
Doug.
would say, our family, of course, we're not perfect. Okay.
Sure.
So,
I know.
Wait.
I know that
Speak
very
for
well.
yourself.
I mean, yeah, we still, but I mean, I would say we get along really well as a family. It's kind of crazy. There's, like I said, all his grandkids, all Doug's kids, 6 of us. Everyone's worked in the business at one point. Right now, 4 of the 6 work in the company, and some of the in-laws work in the family, in the business, of course. And we all get along really well. We do really great. And it's not just the financial. It's the, like you said, there's Doug will mention it. There's 3 dimensions to authentic wealth.
Yes.
And the foundational is the most important to us. So we do a ton of stuff as a family. We were just together the other day on Mother's Day, all together with actually a grandma that's 96. We have one grandparent still living.
I was going to say it really started with them too. It really started with, I know my dad took it and he compounded it. And that's what his challenge was to us. It's like, do more than what I have done. Yeah. It's not like, stay where I'm at. No, Dad's always promoted us to be as and then more than what he was. Just like Grandpa Andrew. I remember when Grandpa Andrew sat me down at 14 and he said, he's like, Emron, what does it mean to bear the Andrew name? And then I'm like, I don't know, dude. I'm 14. Can I go play basketball?
Play football.
Can I go? But he goes on and he established the values that it means to bear this name. And then he put me at a charge. He's like, basically, as I look back at it now, he's like, Emron, don't screw this up. I worked my whole life to put this on right here. I expect you to uphold the family name. And,
It's been fun. It's been awesome. So great mentor. Thank you, Dad, for all you've done.
Yeah.
For us.
Doug, in 60 seconds, can you summarize what 3-dimensional wealth means?
60 seconds.
We got 60 seconds. Emron's timing.
It's a 3-legged stool, okay? And so we have the
55.
financial dimension. There's the intellectual, which is your wisdom, your knowledge, your experiences, everything. And then you also have the foundational assets, which is family, your faith, your beliefs. And so the 3-dimensional wealth, like Emron was saying, it's when I ever ask people, what are the most important assets that you value, that you possess, that you cherish? They know I'm not talking about money. Yeah. And they usually say it's family, it's health, it's our beliefs, these involve people. So we call these human assets. They are our core assets.
Yes.
And so the 3-legged stool, it's like you want to take the wobble out of people's life. A lot of people spend their health accumulating their wealth. Later in life, they're spending all their wealth trying to regain that health, which is really stupid. Yeah. Or they accumulate their financial success and wealth at the expense of relationships with their spouse, their kids, their grandkids, or their God. And then they always say, what was all this for?
Yeah.
I'm not going to take this with me. There's no luggage racks on hearses. And so right. we want to capture the knowledge, attitude, skills, and habits and transfer them into future generations instead of just dumping a bunch of cash, CASH, in their lap. And so that's why we call it 3-dimensional.
Awesome. Beautifully said. Okay, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe. You know you want to. Don't miss any shows. And if you'd like to ask us a question or a comment, make it on this video. We may use your question or comment in one of our next shows. That's all the time we have for today. Keep tax diversification for retirement in mind. Hold on to what's precious. And remember what matters most, the 3 dimensions of authentic wealth. Thanks, everyone, and we'll see you next time.
Thanks, everybody.
Thank you.